welcome to WION World is One. I'm Kanishka Sarkar. Now, it is being called the energy shock of 2026. For months, Indian consumers were largely shielded from the geopolitical fires of West Asia. But the buffer has officially run out. For the second time in a week, fuel prices have jumped by nearly 90 paise this time around. Now, with India importing over 85% of its oil and a vital global shipping lane effectively blocked, the question is no longer just about what you pay at the pump. It's about how much more expensive your daily meal could become. And to break that down, I'm joined by Dipti Deshpande, Principal Economist at CRISIL. Ms. Dipti, thank you so much for joining me today on WION. Firstly, let's talk about your latest report, Shock and Woe report that you have come out with. It warns that retail inflation in India, or CPI, that could jump sharply to 5.1% this fiscal year. That's, just from a benign 2% last year. We have seen that 90 paise jump coming in today in a second time this week. So historically, if you could explain what's the thumb rule like for every 1 rupee increase in fuel price, what is the immediate direct and indirect impact on headline inflation?
Sure, thank you, Kanishka, for having me here. True, I'd agree with you. It is a fairly large energy shock, and I think consumers, for one, have been shielded for quite some time, with government and OMCs taking on most of the price burden. But now with it gradually, passing on, I think CPI inflation, for one, will start seeing some of the impact of these price hikes. So, see, honestly, when you say inflation expected to go up from 2% to 5.1%, it's a mix of 2-3 factors. It also includes the fact that it was at a record low in FY26. So there is a base effect to it, especially coming in from the food side, which was anyways going to lift it to about 4% this year. Now, what the energy price shock does, it takes it significantly beyond that to what we now peg at 5.1%. Now, there have been a number of relationships computed for every 1 rupee hike or, say a 10% price hike. So the last one that we have on record is when in July of last year, the RBI had estimated that the 10% increase in oil prices, for example, tends to push up CPI inflation by about 20 basis points in that particular period. But it's also true that some of these relationships have undergone a change now. At that time, we were operating with an old CPI series. We now have a new CPI series. The revised one assigns a higher weight to fuel prices, assigns higher weight to petrol prices, for instance. So it basically means that some of the impact of these fuel price rises will be felt a little more than perhaps what was felt in the old series. For the number that's going to come up next, we'll only partially see it because only half of May is going to see higher prices. The full impact of a direct hike will be therefore seen when the May number essentially comes out.
Right, understood. And that's about the macro picture, but if we talk about the micro picture, just to put it more simply for our viewers, suppose say an urban family spends about 5,000 rupees on commute, groceries, milk, online food ordering, bottled water. So given the kind of hike that we have seen so far, how much will the weekly expense rise? And also, will there be a lag, like you were pointing out, a few weeks before the common man actually feels the pinch?
That's right. There will be a lag because if you look at it, these are a variety of products. And I think there are 2-3 things to be kept in mind when you want to look at how prices transmit. So for instance, extremely highly perishable items like milk, for instance, vegetables are seeing higher price because of transport cost, for instance. Some of these will see a price hike or rise almost immediately. For a couple others, it will take some time till stocks run out with retailers and you have newer stocks with newer prices come in. But over a period of a month, I think you will see a percolation of all of these price rises go on. How much of it will translate into, higher CPI inflation will be influenced by one more factor. We had the GST price cuts, come in place, and the items that you mentioned, most of these are mass consumption items, which enjoyed lower prices because of GST rationalization. So some of that benefit is also expected to sort of cushion the hike in CPI inflation for the time being. So it's going to be gradual. Of course, consumers will feel the price pinch. But at the moment, they're also enjoying some of the lower prices that came in because of GST price reductions. The third thing that needs to be kept in mind is there will be a little bit of demand adjustment wherever possible, especially when it comes to consumption of fuels. It is often seen that consumers do tend to rationalize some of the demand,
Right.
at least in urban areas. They might want to work from home, they might want to take on more carpooling, for example. So all of these things put together will create an impact on inflation, and like I said, it will be gradually seen over time, first round effects, and then when the second round effects come through, you'd see those as well.
Right. Any back of the envelope, calculation that you have at this point in time?
It's very difficult because honestly, like I said, it will be seen over a period of time. We are not seeing an across the board price increase happen right away, as in how manufacturers are, facing these price rises wherever they feel the need to pass on, or they have pricing power, say where demand is relatively stronger. You're seeing those items on a daily basis. So today you have news on, say, how bread prices are expected to go up. 2 3 days back, there was an announcement of milk prices going up. Like I said, these are not only facing price rises, they have so far also enjoyed a little bit of price cuts because of GST. So net net, the impact is a little bit difficult to ascertain as to which commodity sees what kind of price increases. But if you put all of that together, we are estimating that average inflation this year goes up to about 5.1% from 2% last year.
Correct. Just about that inflation figure, 5.1% is the projection. And, given the current situation, how have you arrived at that number? How much more do you think fuel prices could rise, and how fast could that happen?
Yeah. So honestly, let me give you this example. I think before the West Asia crisis really came in, we were expecting CPI inflation to be around, 4.2, 4.3% in FY27. So it nearly the crisis so far, the fuel price hikes that we are expecting, because we believe that the government is going to, there will be a sharing of the burden between the government, the oil marketing companies, and the consumers. So I think net taking the second round effects into a picture and taking some of the benefits out of GST rationalization, over and above, I think it was broadly an 80 to 90 basis points uptick from our previous forecast. So I think as of now, this is the extent of West Asia impact that we are taking into consideration on consumer price inflation this fiscal.
Got it. And what about the fuel hike that we were talking about? Do you think more is in the pipeline, more could be coming? And if so, how fast could that be?
So yeah, I think, see, as of now, as we know, it was the government and the OMCs that were taking on most of the burden. There was a little bit of hike on LPG that was seen, but over time, because the price hike is persistent and it's expected to stay high, we are expecting oil prices at $92 to $95 average for the entire fiscal. There will be a hump for a little while and then some softening. It basically means that OMCs, which were absorbing losses to the extent of 23 to 30 rupees per liter on petrol and diesel, that came down after the government provided some more relief, and now after the price increases, that's come down further. But the losses that they are bearing still remain high. So as long as there is price pressure, god forbid there is further increase in oil prices because of the uncertainties that we've seen in the last 1 to 2 days, it basically means that some more retail price pass through is something that we should expect.
Okay, some more pass-through is what you should expect. Apart from that, in April, wholesale inflation surged very aggressively to 8.3%. It was driven majorly by the spikes in crude, petroleum, and furnace oil. Retail inflation, it just budged at about 3.4%. But the current situation, do you think today's pump hike essentially means that corporate buffer has cracked and Indian manufacturers are now going to aggressively transfer these input cost hike?
Yeah, I'd say it's a larger story beyond oil prices and gas itself. If you look at WPI, and we've been tracking it for a while, it's not just the energy price shock that manufacturers have been bearing. Second half of last year, they also started experiencing higher, price of copper, for example. Aluminium prices were higher, lead prices were higher. And to add to that, now we are seeing energy prices, oil, gas, and also shipping, transport, all of that put together. So I wouldn't say that corporates are, cracking up. as long as there is possibility of passing on these prices today, domestic demand remains resilient for the next couple of months. We do expect it to remain strong. I think there is pricing power, and as
Okay.
long as that pricing power window is available, I believe corporates will want to pass that on. Now you look at it at the same time to the global part of the arena. On the global side, because costs are going up in general, because there are tariffs in place, because there is weakening demand in many of our larger trade partners, pricing power globally is fairly restricted. So, given that, I think we do expect corporates to pass on some of these prices, not necessarily because they're cracking up, for instance. I think they are in a good position today. Their ability to absorb some of these costs so far has been good, but they're seeing a window of opportunity to be able to pass on these prices to retail at the moment because domestic demand remains fairly strong.
Okay, so that's about domestic demand, but also want to talk about the production side. In your report, you did warn about heat waves and a weak monsoon risk. So if food production slows while diesel prices are high, how badly do you think rural household budgets could be affected?
Yeah. See, I mean, at the moment, I think one of the aspects or one of the parts of the economy which are very strongly supporting growth is the rural part, because we've had good agriculture growth of the last, output of the last 2 to 3 years. Low inflation has benefited. We've often spoken about how, our other reports have spoken about cash transfers to 19 states, which are usually benefiting demand, etc. So I'd say a buffer in the rural economy exists at this point in time, even if prices were to go up. But if El Nino were to be stronger than we had been, for instance, anticipating, and agriculture production is hit, some of those buffers weaken. At the moment, yes, we are worried, and part of our, growth forecast revision, our GDP growth forecast is now at 6.6%, 100 basis points lower than last year. Part of it is because there is an El Nino expected. But I think in addition to El Nino, the IMD has also been talking about a couple of other factors that we need to keep in mind, which can offset. There is an Indian Ocean dipole condition which can offset the intensity of the El Nino. So I wouldn't say that we need to entirely assume that El Nino here is going to completely create havoc for agriculture production. It's a wait and watch, which requires monitoring.
Okay. And, speaking of the buffer that you were talking about, you have also revised the Brent crude projection upward to $90 to $95 per barrel for FY27. Now, given that India imports about 85% of its crude, if global prices hover, persistently near those levels, near 100 that is, for the next quarter, how much room do you think the government still has to absorb before this petrol, inevitably breaches that 105, 110 rupees per mark in metros? In some places, it's already beyond that.
Yeah, so I think that's really the whole different way to look at this particular shock. In the past periods, whenever the energy price shock hit the Indian economy, perhaps from a fiscal perspective, from a growth inflation perspective, from a corporate perspective, things weren't as strong. This time around, our starting point has allowed us to have better absorptive capacity. Like I said earlier, our fiscal deficit is much below where it was before the pandemic hit us. For instance, we've been able to course correct our fiscal position significantly. Growth inflation mix is splendid. I think the monetary policy also has significant room to support if it like to. Corporates and bank balance sheets are significantly leaner today. Our ratings team has put out notes which talk about how strong the credit profile is. What all this basically tells us is that yes, I think some of these buffers will thinner, our resilience will get tested, but from the ability of, for example, the fiscal position stretching itself, banks going out there to support, corporates being able to take some hit on profitability, things are much more in a better shape today than they were in the previous, immediate two energy shock periods that really hit us. So I would say there is room for the government to support, there's room for monetary policy to support.
Okay.
There is room also for households and corporates to take on some of that pinch if prices were to stay higher for longer.
Okay, understood. So there is room for some more support. That's the word coming in. Now, you've also projected India's current account deficit or CAD to widen to significantly to 2.2%. That's up from 0.8% earlier. This, of course, as the rupee is facing very intense pressure. Now, how much of this incoming inflation do you think is purely imported because India is paying more for the exact same volume of energy?
Yeah, I mean, it is part of it. Yes, of course. I think it's in addition to prices in general being a bit challenging here, production taking, some sort of a hit, input costs going up. It is a depreciating rupee and higher imported inflation, which is not only seeping through, the core part of inflation, but you also see it in food inflation, for instance, because we are importing oil seeds for one. So yes, there will be an impact of a weaker currency as well on inflation. But I think in the order of priority, I do not see that as the topmost reason for inflation essentially going up.
Now, Dipti, before we let you go, just also wanted to understand the government is already restricting gold and silver imports to tackle the deficit, right? But any other moves that you see could be brought in to bring down the import bill? And for consumers as well, any alternate budget exercises they could probably initiate so that they feel, the impact is less pinching?
Sure. So yes, I think see, gradually as prices go up, be it of imports or be it of fuel, etc., there will be, like I said earlier, a bit of demand regulation at the consumer end itself. Higher duties on gold, etc., in the past have helped bring down the import bill. So I think the government has managed to so far do undertake actions which are supportive and which could help in some way or the other. But I think what these shocks that are becoming more and more frequent these days telling us is the importance of economic resilience and how that can come handy when these unexpected shocks basically come by. So the government has already had several there are several things in place. For instance, we had GST rationalization, which have made things a little more cheaper. There are income tax relief, which is helping the middle income class, for example. Inflation being low in the last 2 years has basically supported purchasing power. To add to it, the government's spending on infrastructure has continued relentlessly. And the COVID period basically taught us that if you continue on to government infra spending, it tends to create jobs, it tends to put money in the hands of the people who have the highest likelihood to consume. To add to it, we have abundant cash transfers today in the economy. It's a different aspect to debate whether fiscally that is required or not, etc. But at the moment we have those are supportive of consumption. We've seen how the lowest income classes are elevating their consumption just because there are cash transfers in place. So I think as long as the demand side of the economy is kept strong, is kept resilient, some bit of ability to face these price shocks in the short term is there. And I think that's basically the strategy that the government also seems to be pursuing, that is keeping demand resilient.
Okay, so that's the reason why demand looks resilient still. Thank you, Ms. Deshpande, for joining me today on WION and helping us with all of those insights. On that note, I'll let you go.
Thank you. My pleasure.
While fuel price hikes may begin at the petrol pump, the impact rarely stays there. From transport and groceries to household budgets and inflation, higher energy costs eventually ripple through the entire economy. The big question now is whether this remains a temporary shock or turns into a longer inflation cycle if crude prices stay elevated. We'll continue tracking the impact on consumers, markets, and India's broader economic outlook. I'm Kanishka Sarkar. Thank you for watching.